Hope everyone is doing well. Let me see if I can expand TradeStation into the screen. Feel free to ask questions, and over the day, I'll be happy to answer them. You know, I think one of the most important things, and I want to check just one thing really quick here. Can someone comment? I'm just more curious how the video quality looks when I'm sharing the screen. I want to check one of the settings. Can everybody read the bars or the bar numbers? Okay, perfect. So one of the most important things is to be able to trade small. And the reason for that is most people, and I just want to talk about this before I go into the day. Most people, they inevitably trade too large where they cannot make the right decisions. You know, that's why if you ever find yourself, you know, the first thing you have to do is be able to look at this chart at the end of the day and be able to talk about it. You know, can you sit here and talk about the review. That should be one's first goal, to be able to talk about it and explain what's going on. The second piece is, you ever find yourself, doing well, and then you start trading larger, and all of a sudden you start screwing everything up. Typically, the best way to fix that is just to trade small again. That happens everybody's gone through that, where your end goal should be whatever size you're trading is very boring and not that exciting. It's fun to watch the bars, it's fun to see the market play out, but it's very important to, you know, just be, totally neutral about everything, whether it's going up, whether it's going down. And you cannot let emotions with position size dictate what you're doing. So I just wanted to share that really quick. So, as Al always says, whatever position size you think you should trade, trade a fourth of it until you just get really, really comfortable. Well, we had a very interesting day and a pretty good swing trading day. We gapped down on the open and we rallied, and we pretty much formed a spike in channel. Daily chart, first thing, we're right around the open of the week, open of the month. So we can see that right here. Here's the weekly chart, and the market is deciding. Tomorrow's Friday, so that is kind of the final day. What are we going to get? I suspect we're going to have a fairly disappointing bar for both the bulls and the bears. Strong enough breakout for the past 3 days. Probably going to get a small second leg up, so probably buyers below, scaling in lower. But if I had to guess, tomorrow we're probably going to close around the open of the day or open of the week. So if I had to guess, this green line right here is going to be important going into Friday, which is tomorrow. Daily chart, the bulls formed basically a two-legged pullback. We have a high two buy above the current bar, but it's a little problematic. We went outside up, so we triggered the sell below yesterday's low, and we went above it. And in general, if you read the blog, one thing I mentioned was high one buys are great in. I'm not even thinking tomorrow's closed. It's Good Friday. I'll have to check. I can't remember if the market's a half day or if it may be a half day. I'll look in a few, but either way, let me just actually look at that really quick. That is one thing I did not. It completely slipped my mind. Should be at least a half day. But anyways, the point is, looking at the daily chart, we have a high one buy, and high one buys are great in strong trends. In other words, they're great during a breakout where there's going to be a second leg. So where's a good example? There's not any great ones here. Here's kind of one. Broke strongly to the upside, pulled back, high one buy. There's going to be a second leg, probably buyer's above. Now, the reality is this is a high one. The market's probably going to trigger it and either pull back and then go up or go up. So a bull that buys here and buys more lower is probably going to make money. So the question here is, are there more sellers above, and do the bears get a second leg down? That's very common for high ones. Let's find, there's not really any great ones on this chart. But anyways, I think the market's going to go sideways here. We'll probably trigger the buy tomorrow, and either, if the bulls are, well, tomorrow, whatever the next trading day is, we'll trigger the buy and go straight up, or we'll trigger it and go down. This gap right here, May 22nd, is important. Excuse me, March 22nd is important. Bears sold this high and they scaled in higher. And right now the market's deciding, what is going to happen. Why did we stall in this area right here? Well, think about it. If you're a bear and you sold the high of March 22nd during this bar, how are you feeling? You're probably fairly disappointed. So you sell here and you sell more, maybe on a strong bull close. You just sell here. That's break even. So a lot of traders are using the first pullback to exit. If you sell the high of a bar, you're in essence selling a trading range bar. You're anticipating a failed breakout, fading, buying below a bar like this, selling above a bar, like selling above this bar, or selling above this bar right here. You're fading a breakout. You're anticipating the breakout to fail, and you want the breakout to fail quickly. Look at this bar down here. Bulls bought below it, we went up. Bulls bought below this bar, we went straight up. That's what you want. And when you see the move go from here to here, there's going to be trapped traders, and that those traders are going to buy back shorts. It's kind of like what happened, a little bit down here. We have a stop entry buy. The market goes straight up. If you're a bear and you sold the high of this bar, how are you feeling on this bar? You're upset. You're thinking, gee, that's not what I wanted. I wanted the market to, I wanted the bar to trigger and go straight down and me make a profit. I didn't want it to go, basically one times the distance up. And if you're a bull and you didn't buy above this bar, you're thinking, gee, I'm trapped. I didn't buy here. Maybe I should buy the retest of the breakout point. So you'll have bears who are trapped into a bad sell, and they'll use this bounce, testing the breakout point here, to buy back shorts. You have bulls who are trapped out of the trade. They're going to use any pullback to buy and go long. So whenever you have trapped traders, you always have trapped, one side's trapped in the market, the limit order traders or the counter trend traders, and the other traders are the with trend traders. So whenever you get a situation like this where bears, they sell, they get trapped on the way up, they're trapped into a bad sell. They're going to use any pullback to buy back shorts. You have bulls who didn't buy in this area, and they're trapped out of a good long. So they're going to use any pullback to probably buy back longs. And because of that, that will increase the chances of a second leg. We just don't know first how deep the pullback will be. My biggest concern with the daily chart is we are stalling in this area right here. Let me just draw a rectangle around it. We're stalling right in this area. If the market's in a trading range, you really want the market to break. If the market is testing resistance, like this green box, you want the market to break far above it really fast. Like right here, you want the market to break beyond a major support quickly. The problem with trading ranges is kind of like this right here. You break below one obvious support level, but you don't break below the second. We broke above an obvious resistance level, March 22nd, March the 6th, but we're not breaking above February the 6th. So that makes me wonder if this is going to be some kind of a trap. It's very common. It's basically a variant of a second leg trap. March the 13th is a great example of a second leg trap where you're selling off and you get this strong breakout to the downside, and you're thinking, finally, we're going to break out to the downside. I could sell. But you have to look to the left. We're not below these lows. We're not below these lows. And this could just be a higher low. And the bears get a small second leg down that formed a higher low right here, and the market reversed up. So anyways, probably sideways over really the next couple of weeks. Do I think the bulls, if they're really lucky, will break strongly to the upside and test 4,300, the measured move from the low of here to the high of here? But to me, I'm suspicious. If I'm a bear, sure, I'm disappointed, but the reality is, if I'm short and I scale in, I'm probably going to make money. So that is, part of my question. You always have to wonder, whenever you have the midpoint of something, this is the middle of something. We're obviously at a trend line. And if I had to guess, the market's deciding whether or not we test this area up in here or test the March 22nd high first. I want to say one thing about the monthly chart. This is a pretty strong reversal bar this month. And while I do not expect a strong bull close, if the bulls are really lucky, if they're, very lucky, we'll get something like this. I don't think we're going to get that though. I don't think we're going to get a strong entry bar. There's bears that sold below this bar, and my my guess is they're probably going to make money. So if I'm a bear and I sold here and I sell more, maybe at the high of this bar, the market will probably let traders out of the trade. So the market may be deciding right here, do we have to sell off and let these bears out down here before we go higher? If I'm a bear and I went short here, I'm disappointed by the entry bar. And because of that, there's probably buyers at the low of last month right here, which is February, well, the low of February 2 months ago. There's probably buyers at this low trying, and those are bulls that know the bears are trapped, and those are bears trying to get out of shorts. So let's go to the 5 minute chart. I'm going to try and do this for the moment. There we go. So let me adjust one thing on the 5 minute chart. And by the way, whenever I'm trading, I am not looking at this many bars, on a trade station. It's usually, maybe something like this, but typically, I might have 80 bars to the left, but I'm really mostly focused on, what's immediately to the left. And since I watch the E-mini a lot, the E-mini, the S&P, the SPY, I have a pretty good idea of where the daily, things on the daily chart are. But whenever I'm trading, the first thing I do is I look for the obvious prior day's high and the prior day's low. That's the first two things I look at. And then the next thing is maybe the close. So today we had a big gap down, and bar one is a really big bear bar. So you're thinking, gee, it's always in short, sell the close. And that's probably true. But whenever you have a big bar, it will bring profit taking into the bar. Look at yesterday. This is a great example. Find all the big trend bars, just anything that looks bigger than, maybe usual. And what you'll see, big bear bar, sideways. We had a deep pullback. Big bull bar, reversed. Big bear bar, 50% pullback of the bar right here. Bar 15, big bear bar, pulled back here and then had a deeper pullback. Big bull bar, reversed down. Big bull bar, reversed. Big bear bar, reversed. So the point I'm making is big trend bars, usually there's often more buyers at least some scalp distance below. So whenever I see a bar like one, I'm generally suspicious of that bar. I think it's okay to sell the bar. It's better if you can sell and, maybe trade small and scale in higher. But if I'd do anything, I would probably be short stop above one. In general, I'd rather wait for consecutive trend bars because it happens enough where bar one is a big bear bar and then bar two is a big bull bar. The other thing I'm worried about is right here. When I see this, I see a trading range. And let's just pretend that we sold off from 81. Obviously, there was the overnight session, but let's just pretend for a minute that this is a continuous chart. What about these bulls all in here? Bulls bought the 71 low, bulls bought the 52 low. Let's take 52. Do you really think that the bulls that bought the 52 low? I'm trying to draw a line. I keep hitting I've got a keyboard connected to this computer and my trading computer, and it keeps drawing a trend line on TradeStation on my other computer. So I just fixed that. But do you think the bulls that bought the 52 low and are going to buy down here are going to make money? Of course they are. Now, that brings an interesting point, and that is trading ranges. The reason why trading ranges are difficult is people naturally understand the logic. Most breakouts fail, but typically a breakout will go further than you want before it reverses. Bar two, we have follow through. So great, it's a breakout, it's a follow through bar, we're going lower, right? Well, not necessarily. Bar two is testing the low of yesterday. And look at this tail on bar two. That is I want to show this because I think it's really, again, it's really important to get to the habit of having, imagination of the chart. And what that, that's something I heard Ali Afshari say a long time ago, and that is you have to be able to just visualize what the chart looks like. And what I mean by that is big bull bar. What is this big bull bar right here? Well, that is the second or third minute of the second bar on the 5-minute chart. So see this tail that rallied? That's a bull breakout and it reversed. Bulls bought during, below one. In other words, that tail above the bar will increase the chances that the market's going to stall. So think about it. If you sold the close of one, if I'm selling a breakout, I want to see the market just skyrocket down. I don't want the market to pull back, 30, 40% of the bar's range because that means traders bought. If I sold here, I could have sold higher. That means that traders did not necessarily get trapped. But, anyways, consecutive bars, you do have some trapped bulls, probably sellers above and a second leg down. If I'm short, which I did sell here, I think I sold the close of one and sold more on the pullback, or I sold more during the bar. I know I did one or the other. I either sold as the bar went up and scalped out, or I sold and sold more. I'll do that pretty regularly. Bar two, I sold the close, and then I believe I sold more at the close of one. But it's the same thing I'm talking about. It's a trading range day. Now, if I'm selling low in a trading range, I'm prepared to scale in, two or three times and scalp out of the trade. But to me, this is enough momentum that if the market stalls, I can get out. Now, again, if I'm selling closes, I'm in scalp mentality where if the market's going down, 2, 3 points, 4 points, I'm getting out. So for me, on this kind of situation, I'm very impatient. And we sold off and, we reversed up. And I was not alone in that thinking because it's low of a trading range. There's going to be bulls buying down here. So bar three is a reversal bar. Give me just 1 second. It's a reversal bar, but it's a 3-bar micro channel. Remember what I said about the 52 low yesterday? There's probably buyers at this low scaling in. And a lot of those bulls, they'll buy this low and then they may see the momentum down and they'll wait to buy. If I'm buying and scaling in and the momentum, I think the market's going to reverse up, but it may have a small second leg down. I would rather wait to scale in after I see the second leg down. So to me, bar three, there's still sellers above, but bar three is a big, I always kind of like to envision a red light kind of like going off in the room, like something's wrong for the bears. The market's probably going to reverse. Bar four, micro double bottom. You have bears that sold the close at two, and some of them didn't scalp out on three, and then the market reversed. And some of them are thinking, darn, I should have just scalped out. So what are they going to do on four? They're going to scalp. We tried to break below the low yesterday once. We tried to break below it again on bar four, and we're failing. So what does this tell traders? It tells you that this is probably not going to lead to a measured move down. Breakout, you always have to wonder, is the second leg. There's, 90+% of breakouts. Almost every breakout has a second leg. And the problem is that the second leg is often not that big. Bull breakout, pull back, maybe this is the second leg up. Bull breakout, pull back, a big second leg. Bear breakout, pull back, a big second leg. Even 11, it was a bull breakout. 12 pulled back below 11, and then 13 was the second leg, but it made a lower high. So if I'm selling in here and my stop's big, in other words, my risk is big, I need high probability. And if the market starts to stall, I become nervous that again, I have this line drawn at 52 at this moment because I think we're ultimately going to test it. We might successfully break below, but to me, I'm happy if I'm seeing this as a bull because it increases the chances of a reversal. It's also somewhat of, you can call it a wedge or an expanding triangle. It's not a great shape, but we went down, We tried to break below it here, and then we're breaking below it here. And then bar 5 triggered the sell above the 4-bar micro channel, and it's a low one short. Now, what did I just talk about on the daily chart about high ones and low one sell signals? High one buy, but possibly late in a rally within a trading range. So guess what that means? Probably sellers above. Here we have a low one short at the bottom of a trading range. If you're selling at the bottom of a trading range, you know it's a low probability trade. Therefore, if I'm taking a first entry short, it's probably going to have buyers below. So if anything, for me, I'm looking to buy down here. If I'm a bear, I'm looking to for sure take profits. If I'm a bull, if you want to be aggressive, you buy below the low of 5. And one common logic is you buy the low of 5. Maybe you should put a stop 1 times the range of the bar. So you buy this low, stop down here. And maybe you scale in lower, maybe you don't. An easy way to take that trade is I'm going to buy the low of 1. And if I'm right in my premise, the bulls should not make money. The bears should not make money. If I'm a bear and I sell on a stop below this bar and put my stop above, 1 times my risk is somewhere down here. So if I'm buying below the bar, the market should go above this bar before it reaches a target for the bears. And then you can see the risk is pretty small and it went up. So that's a pretty common. I think a lot of traders trade that way. I'm trying to think of an easy example. Where's a bad, kind of like right here. Here's a bad low one, but it's an inside bar. Kind of the same thing. You could say, I'm going to buy below this bar and put a stop, 1 times the risk. But the problem with that is the bar is an inside bar. And if we fall, we could easily fall below 37 and then reverse up. So for me, if I'm doing that, I might use a stop, something maybe twice the size of this bar. And a good way to do that, if I'm uncomfortable with, you know, the risk reward and understanding the probability, I might buy the low of this bar and use the stop somewhere down here and go for twice my initial risk or actual risk. So if the market goes down 1 or 2 points and then immediately reverses up, maybe I try and get 2 or 3 times my actual risk. Bar 6 is a problem for the bears. It's 3 pushes down, 3, 4, and 6. So it's 3 reversal attempts that failed to break out below yesterday's low, and the market's reversing up. That is not good for the bears. So for always in traders, bears exit above 6, aggressive bulls buy, forcing traders to buy the top of a trading range. We went down on this bar, down on this bar, and down on 6. We went up on 3, up on 5, and up on 6. So it's basically a final flag. It's an expanding triangle. 3 pushes down, 3 pushes up. And then we had a breakout up to the 52 low. So think about what happened here. Some bulls, they buy the 52 low. They buy more above the bar 7 or bar 6, and they scalp out. Consecutive bull bars on 6 and 7, probably always in long. But one of my concerns is it's a tight bear channel, and it was reasonable to sell down here. Even though, and when I say reasonable, I mean one of 2 things. It's either going to be a bear trend or it's either going to be a trading range. And obviously, we can get a measured move up or down in this range. So, yes, it may not necessarily be a bear trend. Give me just 1 second. But what I mean by that is there's probably sellers above scaling and higher. So if I'm a bear and, pick a reasonable place, I'm going to sell this low 1 right here. So I sell the low 1 here and I use to stop, really far away. Maybe I use to stop a measured move up of this range. So I put a stop up here. What a lot of institutions might do, even though it's a bad short, they sell below 1 and they wait and sell more below bear bar. Would they sell below 10? They might, but do you really want to sell after 4 strong bull bars? Probably not. So I think a lot of traders will wait for some kind of second entry. What's a second entry? Probably something like 14. That's reasonable. traders sell below 5. They sell more below, maybe 15 micro. It's a double top, 10 and 14. I said 15, I meant 14. And that is break even on the entire trade. If I'm a bear and I sold anywhere in here and I see this as the, rally against me, I'm going to get out of the trade as quick as I can. So the bulls are buying down here. That's the problem with this being buy the close and always in long. It probably is always in long, and you're probably going to get a second leg, but you may get a really deep pullback. So for me, I'm willing to buy. I'm buying a pullback, and my stop's down here. I'm happy to scale in because I think there's going to be a second leg. Buy the close here, same thing. These tails is selling, so it's a warning that something's wrong, but I think it's reasonable to buy the close, stop down here. Buy the close again. Certainly reasonable to do and probably going higher. Buy the close below the bar? Yes, but there's one big problem with this right here, and that is we sold off and we have a pretty strong reversal. That means there's trapped bulls and bears. You have trapped bears who are short, they're trapped into a bad trade, but you also have bulls who are thinking, yeah, this is a big sell off, this is a big rally, big down, big up, probably going to go sideways and probably going to have a deep pullback. More than 80% of the time, maybe 85% of the time, bears, traders can make money, traders can avoid a loss. So, what does that mean? Let's find a good example here. Here's one 7, outside down bar, a very, emotional bar, forcing traders to sell low in a trading range. But look what happened on this pullback. Anybody that bought in here and just bought more lower, guess what? They made money. Big bear bar, probably going lower, emotional, traders sell the close. But anybody that bought in here and bought more lower, guess what? They were able to avoid a loss or make money. So what do we think is going to happen here? Well, we know the answer. The bears that sold down here and scaled in are probably going to make money. That is why whenever you get a lot of selling pressure on the open, you typically do not get an immediate bull trend from the open or a bear trend from the open. You've heard Al say that a lot. Whenever you get a lot of, a big bear breakout or a big bull breakout on the open, typically the market goes more sideways. Reasonable, you can exit below 10, and some traders will. Other traders, when they see 11, they think, gee, that's a big bar and it's probably going to have a second leg down. So if the market's going to have a second leg against me and I'm a bull and I'm long below 10, what am I going to do? I'm probably going to scalp. Remember what I said about high ones? This is a pullback, so 12 is a high one buy. Because 12 is a high one buy, after a pretty big bear bar, it will increase the chances of the market getting a second leg down. There will be traders who will buy above this bar, and they're using a very wide stop, and they're going to buy more lower. There's other traders who will say they're disappointed by 11, and they're going to use the pullback on 12 to sell out of longs. So that's why you see 10, you see 11 break below 10, and then you see 12 pull back to the 11 low and find sellers. If I bought the low of 10 and I'm disappointed on 11, what am I going to do? I'm probably going to scale in, but I'm also probably going to scalp out of the trade. And that's in part why we sold off a little bit there. Now, the opposite side of that coin is if I'm a bear and I look at this and I say, yeah, we're going to have a second leg down, I should sell the close. And I'm selling, maybe I'm betting on, an endless pullback or a sharp sell off. And then I see 12 and I'm thinking, darn, this isn't going to be a pullback in a bear trend. This is probably a trading range or bull trend. So if I sell the close of 11, what am I thinking on 12? I'm disappointed. So maybe I sell the close of 11, I sell more at the breakout point, the 10 low. But the point is, what am I going to do on 11? I'm probably going to buy back a short at the 11 close. Look what happened on 12, or excuse me, 13. 13 sold off, let all the bears out that sold the close of 11, and then they got out and traders bought. Now we have traders that bought the 9 close. Buy the close traders. If I'm buying the close of 9, I'm buying expensive. That's relatively, the risk is pretty big for the bulls. Stops down here. If I'm buying the close of 9, think about that for a second. I'm paying a lot. So if my risk is big, What am I hoping for? I want the market to go my way rather quickly. If it doesn't go my way, I'm going to buy more lower and probably scalp out of the trade. So, what are traders going to do back at the 9 close? They're probably going to sell out of longs. What are the bears going to do at the 9 close? The smart ones are going to say, yeah, if I'm a bull, I'm disappointed. I'm going to sell out of longs. So, if I'm going to sell out of longs, if a bull's going to sell out of longs, what do the bears do? They short. We had a really good example of that on the euro dollar. Let me pull that up real quick. I think it's worth mentioning. And while I'm pulling this up, it's really important to study all sorts of time frames. Study 1 minute charts, study daily charts, weekly charts. You have to really learn to believe that price action is fractal. It works on the logic of price action works on all time frames. So look what happened here. We haven't quite reached it. I still think we have to reach this line. This is the daily chart of the euro dollar. And if you've been keeping up with the blogs I've been writing, I've been talking about the February 1st bar. It's a buy the close bar, and obviously traders are very disappointed with the sell-off. And the market is testing this high. But look what happens every time it gets close to it. Traders sell. Those are also bears knowing that bulls are disappointed. So that is, just wanted to bring that up really quick. It's going to be that's what happened in part on the close of 14. We tested the close and went immediately down. So 14 is 2 legs down. Leg 1, pull back, leg 2. And in trading ranges, I just want to point another thing out. It's very common to fall below trend bars, like 9 strong trend bars. And it's very common to go above strong bear trend bars, like 11. So 14, second entry short. What do you do there? Well, it is reasonable. There's logic to exiting the trade here on 14 if you're a bull. And you can handle it in one of two ways. Bulls exit below 14, second entry short, possible top of a trading range, the trading range being the bar 1 high. They exit shorts, and if the next bar is like 12, closing, maybe closing on its high, they can buy again. The reason they would exit is the sell-off might go all the way down to here. So if the market is in a trend, the pullback's probably not going to pull. It's not going to pull back that much, and it's going to go, for a second leg. If it's in a trading range, though, where are obvious targets? Well, one target is the 5 low. So it's possible we get all the way back down to the 5 low. We had a big sell-off, a big rally. The bears, what do they want? They want a lower high. So it doesn't seem, it never seems like that could be the case, but it happens, often enough. Let me pull up. I think this happened in like the euro dollar in like a 240-minute chart. I'm just trying to find examples of kind of like right here. You have a strong upside breakout, and it's a test of a channel. So here's the bottom of the channel. Maybe that's the top of the channel, and we're really close to it. So strong bull breakout. Bear bar follow through, probably going to get a second leg. And then when you see this sell off, if this is a trading range, we could fall all the way down here before we go sideways. So even when you see these bars, like this big bar here, and then it be a bull bar, you always have to wonder, trading ranges have very, much deeper pullbacks than what would seem reasonable. So like here, if this is a trading range, this might be some form of a trap, and we could sell off all the way down to here. So that's why a lot of traders would exit. If that didn't make any sense, make a comment and I'll talk more about it. But the point I'm making is if bulls are buying and their risk is big, they need high probability. If they do not think the probability is high that we're going to get some sort of measured move up from the low of 6 to the close of 9, traders start to exit. And if they start exiting, we could sell off quickly. That's what happened down here. We were selling off. We tried several attempts to go lower. And then right in here, everybody concluded we're not going a lot lower. So then the market quickly reversed up and we tested one of the lower highs. Surprise breakout on 15, probably It might get a small second leg down. It's a little bit of a surprise, but it's testing very important support levels. Bears got trapped selling in this area, and bulls got trapped out of longs. Therefore, traders buying in this area, there's going to be traders buying in this area. Bears buying back shorts, bulls buying, scaling and lower. 16, a bull bar, but bulls that bought the 13 low and more lower were able to make money. 16, it's not a good stop entry buy. It's above the bar, but do you really want to sell below it? It's a low too short, but there's probably buyers below 16. And then 17, inside bar. So now we have, you know, almost an inside bar on 16, an inside bar on 17. We're basically forming a triangle, and that increases the chances that a breakout up or down will fail. Just one moment. 18, we tried to break below 17, reversed up. So again, I said a triangle increases the chances that a breakout will fail. We broke to the downside and we reversed up. 19, strong reversal up, testing the high 2 buy or the high 1 at 12. Remember what I said? I said bulls would buy above 12, use a very wide stop, and buy more lower, like above 18. And then they're going to decide on 19 whether or not to exit. So the bears tried to get a reversal. They're failing. A lot of bears exit here. Bulls, strong surprise, probably going to go higher. They start buying, betting on a second leg up. So the question here is everybody knows we're going to get a second leg, but how big is the second leg going to be? The bulls, they need to break above these resistance levels. So what are these resistance levels? These resistance levels is the 9 close, the high of 10. This is where traders got trapped. Bulls bought the 9 close, disappointed on 11. And what happened on a pullback? Look what happened on 13 or 14. The market retested the 9 close and turned down. So the market needs to break through this price level. So the next bar is very important. 20, bull bar, closing, at its midpoint. A little bit disappointing, but 3 consecutive bull bars, probably buyers below. And then 21, another bull bar. It's becoming weak, but it's still a fairly tight channel, and it's not quite ready for a trader, not really good enough to sell yet. This is profit taking, and we could still get an upside breakout. 22, another bull bar, and another bar added to the micro channel. It's an inside bar, so it's basically a high 1. It's a breakout, pullback, buy. Reasonable to buy the bar, though. It's a tight bar. It's tight channel up, a micro channel, and you have to wonder if the bulls are going to get an upside breakout. When you look at this and you think about the bulls that bought the 9 close and they scaled in lower, like above 18, you have to ask yourself, the bulls that bought above the 9 close and bought more above 18, does it look like they're taking profits here? Or, some are, but you have to wonder. It looks to me, when I look at this, it looks like traders are starting to swing. 22 or 23, bear bar, but it's the first bear bar since 18. And the Bears have not made money below a bar in several bars. 24, doji, so probably buyers below. And then 25, another doji. We're getting a lot of dojis, but dojis they are trading range bars, but context means everything when you look at a doji. So whenever the market's forming a tight channel, these dojis become more trending bars than trading range bars. So the first thing I always think about is, are there more stop entry traders below the bar? Are stop entry bears going to make money? And if I can answer that really quickly, no, they're not going to make money, then that will increase the chances that we're probably going to pull back. Or excuse me, that will increase the chances that we're probably going to go higher. 26, a give up bar. So we broke above the trading range here, and strong enough breakout, probably by the close and probably going higher. Another thing I want to point out is 23 broke above this range. 24 broke above it again. 25 broke above it more. That increases the odds that the market's going to try and break to the upside. See one thing here. Excuse me, just really quick. There we go. Strong breakout, follow through, probably buy the close. If I'm a bear and I'm short for any reason, there's no way I can be short after I see 27. And really, I shouldn't be short if I see 26. So if I should not be short on 26 or 27, what should I do if I'm a bull? I should buy. So it's buy the close, stop down here, trader scaling in. Bull bar, but big tail, so bulls bought the close and they scalped out. Bears sold the close at 2 and they scalped out. So probably going to pull back soon and probably not going to rally for the rest of the day. Inside bar on 29, but a doji. It's a high one buy. We had a breakout, pullback buy. But remember what I said about high ones. High ones are good when you have a strong breakout. 26 and 27 and 28 is a strong breakout. So yes, there might be more sellers above, but if there are sellers above 29, they're scalping. They're selling the high of 29 and trying to get out, for a very small profit. So even if you buy above the bar, there's going to be buyers below 29. So who cares? Just buy for any reason. And that's the mentality that a lot of bulls have during this situation. That's the mentality that traders should have. So buy the close, need a wide stop, and scale in. Good bar on 30, closing on its high, becoming a little bit climactic, may pull back soon, but the traders that are buying and scaling in using wide stops are clearly making money, and bulls are clearly not making money. Climactic bar on 31, trying to get to yesterday's high, probably going to get there, but becoming a little bit extreme. And this is not sustainable, therefore, probably going to get a deep pullback fairly soon. Have to think about measured move targets. So I forgot to draw this, but one was here. We just reached that. The next target is probably the extreme of the breakout, the low of 6 to the high of 9, which takes you a little bit higher. Bear bar 32, okay to exit longs. The risk is pretty big. Moving average is far away. And, partially why 32 happened is you have a lot of bulls when they see 31, they see it as a gift. Bulls bought and, they quickly made a windfall of profit in 2 bars. So they're going to take it. But there's also going to be bulls buying pullbacks. These tails rallied, pulled back is traders, taking profits, but other bulls buying. So here, the high of 28, low of 29, that's a pullback and went from here to here. So if I measure it, look what happened. So what do you notice that happened on this bar? We went up and pulled back the exact same distance from here to here. We're probably going to pull back more, but that's a way traders can gauge how far, where to buy. And we got a second entry short on 34, this bear bar right here. 35, second entry buy. Traders can buy above it, but we're forming a tight trading range under yesterday's high. Probably going to pull back soon. And then another bear bar, and then another surprise, broke above yesterday's high. 30 and 31, climactic bars, reasonable to expect a small second leg. But at this point, what do you do? For me, I would just wait. Yes, we can certainly go higher, but I'd rather buy a pullback at this point, even if we just keep going up. This is becoming very extreme. But we still have other targets above high, yesterday's range, probably too big, or at least this trading range. 40, we had another inside bar on 38. So we had an inside bar on 29. We went much higher. We have a tight trading range, which is basically an inside bar on a higher time frame, and we broke above it. But the problem with inside bars is they're magnets. So kind of like what I said here, inside bar, we broke below it, reversed up. We have an inside bar area in here. We broke above it. Guess what we're doing? We're reversing back. So when I see 38 as an inside bar here, I'm even more confident that we're going to probably try and break above it and then fail. So for me, if I think we're going back here at a minimum, I'm exiting, I'm getting out of longs below 30, or below 40, no question. 42, big bear bar, a little bit of a surprise, probably going to go a little bit lower, but traders buying and scaling in. And you can see bulls bought below 41, scaled in lower, they made money. And 4-bar micro channel to 43, they scaled in higher, they made money. I'm going to speed this up just a little bit because because I'm running a little short on time. But let me kind of go back to the good stuff here. So we sold off, and in this area, whenever you rally for like 20 bars in a fairly extreme move, for me, I want to see a test of the moving average. And because of that, I become a little nervous to buy areas like here without getting to the moving average. So at this point, probably entering a trading range. Remember what I said here? Any breakout above is probably going to retest this area. Well, now we have an even bigger trading range. And what do you think I'm going to say? Any breakout above it is probably going to retest that area. So surprise breakout on 66, strong enough bar, probably at least a second leg down. And because we're in a trading range, what are targets? Well, it could be the 54 low, it could be the 42 or the 43 low. It could also be the apex of this area in here. And then low one short on 68, but strong enough bear bar, probably a second leg, 69, 70. Decent sized bear bars. Is it always in short? It might be, but we've been above the moving average for so long that there's probably buyers down here at the bottom of a trading range. And then a doji with 71. Had I sold the close of 70, especially with the tail on 69, if I sold the close of 70 and then I see 71, for me, I would get out. It's not worth the risk. The risk is really big, stops up here, and you're probably not going to go a measured move down. If anything, you're probably going to go sideways. And if you're going to go sideways, I don't want to risk this much, which is why that happened. You also had bulls buying in here. We have inside bars. Inside bars are trading range bars. So you know what I'm going to say. Bulls bought in this area and scaled in. Guess what's happening? It's allowing them out of the trade. You even had bulls that bought the 65 low and they bought more lower, and they're getting out of the trade. And we pretty much went sideways for the rest of the day. So for stop entries, I thought it was reasonable. Let me talk about always in for a second, because that's probably the most important thing to learn how to trade. Probably always in short on the close of 2, but for the reasons I stated earlier in this video, I'd be quick to exit. And, bulls get out. Bears get out above 6, aggressive bulls buy, and then we're always in long, maybe on 7 or 8. But because of a possible trading range, you expect a deep pullback. If I bought here, I'd get out below 14 and then I'd wait. I wouldn't sell. Aggressive bears might, but to me, it's not worth it. So I'd get out of the longs. I'd buy again above 18, certainly above 19. No reason to really get out anywhere in here. You can get out below 40, but if you do, you have to be pretty aggressive to buy again. And, maybe you get out below 48, 2 legs up, test of a double top. You can exit there. No reason to sell, no reason to buy. And then maybe you buy above 56 and, get out below one of these bars in here. But to me, I don't like to trade always in. I like trading always in when you get strong breakout bars. And I used to be much more aggressive about always in. But for me, I'd rather trade with limit orders. And if that's the case, I want to buy below things and sell above things when the market's in a tight trading range. For limit orders, traders buying below bars, scaling in lower. I thought, the easiest limit order trades, buying below 5, buying below probably 17, or buying as it turns up, buying below 23. You can buy below these, but hard to do. The risk is pretty big, and you can get a pretty sharp bar down in the second leg. It's not ideal. Buying below 53 is reasonable. And all through here, when you're this far above the moving average, it's just buy below anything. Buy the close, sell the close. Probably sell the close of 2, but you have to be quick to get out. Buy the close of 7, 8. You can even buy the close of 9, but 9 is a climactic bar, and that will increase the chances of a pullback. If anything, do you sell the close of 11? I'd buy it, if anything. But, if you're buying, it's a scalp, because, bears are going to sell back at the 9 close. Probably, again, probably buy the close on 15 for at least a scalp. And then buy the close 19, 20, 21, 22, any of these closes. And then it's especially buy the close 26, 27. If I did buy the close anywhere in here and the market starts to go sideways, I'd be very quick to exit longs. And for me, I bought up here, and when I started seeing the sideways movement, I got out. I thought there was too much risk of testing back down to here. And I bought again when I saw either 26 or 27. I can't remember. and buy the close anywhere in here, but climactic, so may go sideways soon. Buying the close of 37, same problem. Not really ideal because you could pull back to here, so I would not buy the close of this. And if anything, I think traders are buying bear bars at this point. What about buying the close of 66? You can, but it's a little bit of a surprise. May get a small second leg down, and that's probably all I would do today. Let me take a quick look at questions. I shorted below 68. What do you think about it? Yeah, it's what I talked about. It's a low one short, 66 strong enough for a second leg. I think that's, okay. Let me see here. I don't pay attention to volume oscillators, so I'm not the person to ask on that. That was someone's question. Kindly explain hybrid indicators. Again, I don't pay attention to any of that. So here's a question. Hi, Brad. I just bought during 15, testing the 6 high. So they bought during 15 as it tests the 6 high. I think that's a really good trade. Great entry. If you bought during 15 as it tested the 6 high, that's really good. Bears sold in this area. They got trapped. So the bears are going to buy back shorts. So great place to buy. So that's so far so good. Logic was second leg trap. So they thought that this was leg one, pull back, and that was going to be leg two. I think that's very reasonable as well. After a strong leg up, I put my stop below 4. Yes. Hoping for a second leg up. Any thoughts? Yeah, I think overall that certainly a good trade. For me, the only thing I would tweak with that is if I'm buying, two things. If I'm buying the on a limit order as 15 is testing 6, I would just scalp out. Because if you think about it, think about it like this. You know that there's traders on the sidelines waiting to buy on a stop entry. Therefore, if I buy as 15 goes down and I can quickly make, 3, 4, 5 points during 16, which is what happens, I can scalp out. And then if the bar closes on its high, I can buy again. So a lot of traders will do that. They'll scalp out and then they'll wait for the bar to close on its high and re-enter. But overall, I think that's overall, a really good trade. So I think that's, good job. Do I trade options? No, but I will at some point. That's Al's done it a lot. I've got lots of notes on Al, but right now I really just trade. I trade the SPY. I'll trade a lot of micros. I'll look at the Emini. So I guess to answer that question, really simple. I look at the S&P, and I will typically trade Forex. But that's pretty much it at the moment. Traders buying 8 and 9, 8 and 9. So these two here's a question. Traders buying 8 and 9 have to be willing to scale in. I think they should, yes. So someone asked, should traders, if they buy the close of 8 and 9, be willing to scale in? Yes. Is a stop below 6? Yes. So is the stop below 6 far enough, or would a measured move down be better? What is the minimum profit target? Yeah, so that kind of turns into the premise on the trade. If this is going to be a successful breakout, we should not fall to the low of 6. If it's going to be a trading range, we could easily fall below 6. So the problem is if I'm buying anywhere in here, I want to be quick to exit if it doesn't go up because the risk is big. That's what I mentioned. That's why I said a lot of traders would exit below 14 because we could easily sell off all the way down to here. And think about it. If I got out on 14 and I wait for a bull bar, I'm not going to buy that. I'm not going to buy that. We have a bull bar. I'll buy here. I actually got in at a cheaper price if I did that. So a lot of traders will do that. One of the biggest, most important things, and I'm hoping to do more of like a, maybe on a weekend, come on here and do like a Q&A and talk about this. But I think a lot of traders need to really pay close attention to their, one-to-one risk reward is really bad risk reward, and you need high probability. And that's what screws traders up. They sell the close at 2, put a stop above 1, which is the right thing to do, but they cannot assess quick enough when the probability changes, like above 6, and they take too big of a loss. So for me, if I'm buying, I would get out here and look to buy more above a bull bar. I would get out and then look to buy again. Okay, question, how come in a trading range will sometimes test the low of the range, but other times test 50%? Yeah, it has to do with how trapped traders are. So if you're a bear and you sold here, where's an easy example? Here's a good one. So if you're a bear and you sold down here and we went above the highs, but we also went down to these lows. So bears sold, they scaled in, they made money. So the bears didn't feel that trapped. The bulls trapped the bears here. And what traders pay close attention to is, will traders be able to make a profit, or will they get squeezed out of the trade? And here, bears had a brief window to exit the trade. And if they didn't, they got in a lot of trouble on the way up. So that's what caused this rally. The bears got squeezed on these two bars, and the market went up fairly quickly for a measured move. Okay, I've got time for like one or two more questions. You were scaling in. At what point do you decide to give up? When my premise changes. So for me, if I'm scaling in, I'd be careful about scaling in. For me, if I'm scaling in and I'm always getting out if it makes sense to get out, like below 14, I would get out. And because I think it's really hard to hold through a pullback. But if you're buying the close in 9 and your stop's below 6, as long as you're willing to stay in the trade, then it's okay to scale in. But the way I would do it is I would buy the close, stop below here, and then wait and buy more above the bull bar. I would not buy and then buy in pieces, because most people will end up risking too much. Why was 18 a good buy bar? For the bears. If I'm a bull and I got out below 14, I'm looking to buy. And for the bears, if I'm a bear and I sold below 10 or the 11 close or below 14, I may give the market, 2 or 3 attempts down. But 18 is a third attempt down, even though it's basically a truncated wedge. 12, 15, and 18. Even though 18 didn't go below 15, it's still a wedge. And it's a possible failed breakout. And if the market's not going to reverse all the way down to here, you have to wonder if the market's going to go to the upside. So that's why 18 is a good buy. The bears have to get out, and aggressive bulls will buy. Okay, so I hope everyone has a great rest of their day, and I will talk to everybody soon.